Yeah, thank you very much, Wayne. Now, Peter, it's your turn. I mean, everyone has shifted the responsibility for being entertaining to you.
Well,
but since you arrived this morning only from Germany, so you might be too tired, actually. But please start.
I try to do my very best. Thank you very much for inviting me. This is the fourth contribution to this afternoon session. I think it fits very nicely into what you have already heard. As I'm a macroeconomist, I have not so much to say about governance and compensation. And I'm now very happy that the specialists have now found out that these governance issues are not of primary importance. So I feel very comfortable for not having gone too much into this question. And so what I want to address is a question that was raised by Charles Calomiris this morning: how to create uninsured debt, because I think this is one of the major reasons for excessive risk, and it was already said that all these too big to fail issues are of high importance. And the question is it possible to create uninsured debt? How can we do it? And well, I found an answer in a very interesting publication which just came out 3 days ago by the Institute for International Finance on systemic risk and systemically important firms. And the answer is relatively simple. That's what they wrote. No firm should be considered too big to fail. And they say it should be possible for all firms to exit the market in an orderly manner without causing systemic damage. Well, this is, as I wrote, first commandment, I think, not only for financial markets, but also for any market economy. Firms have to go bankrupt. The question is, how can we do it? And now, after more than 2 years of the financial crisis, I think the possibility of banking firms to go bankrupt or of debtors losing their debt has become even less than it was before, because first we had these huge rescue programs, and they have now convinced everybody that if you invest your money in a large bank, it will be saved. So the implicit guarantee of the government for banks, for bank deposits and for bank debt is now stronger than it was before. And I think this is one of the really negative incentive effects of the crisis, that now you can feel more secure than you did before. And at the same time, we observe very high interconnectedness between banks. So I have here the data for Germany, where you can see, for instance, our big banks have 40% interbank assets, more than 30% interbank liabilities. So there's a huge connection among banks, which makes this too big to fail problem a very serious problem. What is wrong with the too big to fail problem? Well, I found this, the main arguments in a nice book review by Frederick Mishkin. And well, you all know that the too big to fail problem increases the moral hazard problem for big banks, because if the depositors know that a bank cannot fail, they have no incentive whatsoever to monitor the bank, and of course this creates for the big banks, large banks, a possibility to incur greater risks, and therefore bank failures become more likely. So that's one of the questions that was raised this morning: where comes excessive risk from? Because that is not so clear. And I think maybe that's not the only source for excessive risk, but of course, if banks are too big to fail, and the debtors have no interest to monitor it, of course, this creates such moral hazard problems. The question is, how do we solve? So it's easy to say, well, banks should be able to fail, but how do we solve the too big to fail problem? Well, there are several solutions on the table. There are proposals going on in the US Congress and Senate, which envisage some form of size limitation. So somehow you have to limit a bank from coming too big. There is a Volcker rule, which has the idea, well, you have to separate commercial banks and investment banks in order at least to make the commercial banks safe. In Germany and also in Europe, there's the idea of taxes on systemically relevant banks. So the idea of a kind of PIGU tax, which helps to internalize the externality that is created by systemically relevant banks. The IMF in its recent recent financial stability report has the idea of higher capital requirements in the form of a systemic risk-based surcharge. And what I want to propose and explain later on a little bit is a kind of diversification rule as a way to address this problem. So if one wants to solve the too big to fail problem, I think it's important a little bit to find out what is the root of this too big to fail problem. Where does it come from? And I think, at least in the recent crisis, the main cause for this too big to fail problem is that the insolvency of one bank leads to the insolvency of other banks. So these kind of domino effects. So the problem of too big to fail is that banks have a very high exposure vis-à-vis another bank, and if this bank goes bankrupt, it also leads to the bankruptcy of other banks. So this is kind of a domino problem. And so far, at least in the current crisis, I would say the main problem of the main way how the too big to fail problem is expressed is a too interconnected to fail problem. And if you see the problem as a too interconnected to fail problem, you find out it's not so much the size of a bank that matters, but it's the fact that you have banks that invest their money in other banks and that these banks are not sufficiently diversified. This is, in my view at least, one in the present crisis, a very, very important explanation. And you have examples for this. The financial crisis broke out with the IKB bank in Germany, which was about the 20th largest bank of Germany, so really not a large bank, but that was, at least in the beginning, regarded as a systemically relevant bank. Of course, then we have the big ones, AIG, but in Germany, Hypo Real Estate, Commerzbank, all banks who were systemically relevant because they had very strong linkages with other banks. And to show the problem graphically a little bit here, to simplify it, you can have a large bank which has no problem, which is not really systemic, if it gets its money from other banks who have only a relatively small proportion of their total assets invested in this bank. And you can have a smaller bank who can be systemic if it gets money from banks who are not very much diversified. So I think that's an important way to look at it, to see that this interconnectedness is not necessarily related to the size of banks, but it has a lot to do with the diversification of banks, or also in pension funds, that invest their money in a bank. And if you see this as the main source of the too big to fail problem, it's clear that if you have size limitations as a solution to this problem, it's not sufficient because, well, as I said, even a middle-sized bank can have such domino effects. And as a report by the Institute for International Finance shows, there are many good arguments for banks to have a larger size, and it's very difficult to argue that a certain maximum size is reached or to determine optimum size. So I think size limitations do not really contribute to the solution of this connectedness problem. And the same thing is if you have narrow banking or Volcker rule. If you have commercial banks investing their money in investment banks, and if these commercial banks are not sufficiently diversified, again, you have the problem falling back on the commercial banks, and you have to save the investment banks because otherwise they would have negative impact on the investment banks. So also the narrow banking would not really help to address the problem. The same thing if you have these Pigouvian taxes. They sound nice, and everybody who knows something about externalities knows Pigouvian taxes. This is really a good way to internalize externalities. But if you see the problem of the pollution in lack of diversification in banks who invest in another bank, the polluter is not the big bank who receives the funds, but the polluter are the smaller banks who do not sufficiently diversify. And so if you have a Pigouvian tax for the large bank, it's not the one who creates the externality. And so it's just not addressing the cause of the externality. The similar thing is if you have systemic risk-based surcharges as the IMF is proposing it. Again, the problem is not the bank which receives money, but it's the banks that invest money, and I think it's extremely difficult to capture these risks of interconnectedness in just some simple basic surcharge. I think it was with Henry who said relatively clear how difficult it is to capture all the risk and all the instruments. And I think if you really try to capture this with a surcharge, I also think it will be relatively difficult. So what is the solution? Well, I want to propose something which is relatively simple. And on the other hand, I think it's relatively straightforward. I want to propose a simple rule that also allows to overcome the time inconsistency problem with which regulators are faced. And one approach to limit all these interconnectedness problems is just limit the exposure of one bank with another bank to 10% of its capital. Why not just limit this? That's a very simple rule. It's not very difficult to calculate. And the rationale is also obvious. If you do this, one or two big banks can fail without jeopardizing other banks. Simple and robust rule. And then if you have the rule, there is also no credibility problem. Because if you know that all banks have a financial structure that allows the bankruptcy of one or two major banks, you don't have to discuss it. Because that was, in my view at least, in Germany, one of the things that was always disputed: is this bank now systemically relevant or not? Nobody knew it. And if you know from the capital structure, well, it is able to withstand at least the bankruptcy of one or two banks. Then you don't have this problem of time inconsistency. I think the advantage of this proposal is you do not have to interfere in the structure of the banking industry. Banks can decide whether they want to be investment banks or whether they want to be commercial banks. You do not have to make any prescriptions on the size of banks. You do not have to burden banks with taxes. And, well, of course, such a solution, such a proposal is not a panacea. So if you have too many to fail problems, of course, it doesn't help. And if you have only one or two banks, it's also not helpful. The question is, how realistic are such rules? I know in the United States, people do not like really this interference in the market that the government is prescribing 10% is a maximum exposure that you are allowed. I think you know more the price-related structures, but when you are in an environment where it's difficult to capture the risks, and I think maybe the robust rules are better. I think that's also one thing we learned with the Basel rules, which are also very sophisticated and try to get to capture all the risks. And in the end, we found out, well, it's difficult to really adequately describe the risks. And so I would say, why not have such a simple rule? Is this realistic? Well, in Europe, we have already the Capital Requirements Directive, Article 111, which prescribes a limit of 25% of the total exposure of a bank vis-à-vis other banks. This has now been reinforced. Before the crisis, it had many loopholes. Now, most of the loopholes have been closed, but there are still major loopholes, especially if there's lending within financial groups. In the United States, I found Regulation F. And I first thought, well, they have it too. But Regulation F says, well, there's also a 25% limit unless the bank can demonstrate that its correspondent is at least adequately capitalized as defined and so on. So as long as if you're doing business with adequately capitalized banks, there is not such a limit. But if you just stop here and get away with this unless, then you would also, it would be relatively easy to put that in place. Well, okay, so the interesting question, and I think this is only a very rough proposal, the interesting question is, how much bank interconnectedness do we need? I think that's the crucial question. because if you reduce it, you have to ask what are the economic disadvantages. What is the, or put it the other way around, what is economic benefits of banks playing with each other? And I'm not so sure, because if you look at these huge interbank liabilities and assets, the question is, isn't that a zero-sum game, what these banks are doing with each other? I don't know it. But the question is, if you want to reduce it, this would definitively lead to a new financial landscape, less speculative transactions between banks. I think the role of wholesale banks would be reduced. Of course, such a rule would have to be extended to insurance companies and pension funds, because otherwise you get the same problem with these institutions. And I think if you would really implement it, you would have a stronger relevance of mutual funds, because if you no longer use banks as intermediaries, you would get more direct connections. And in this respect, I find quite interesting the proposal of Kotlikov with the limited purpose banking, as it's something he had in mind as an alternative to banks, and maybe that would help. Yeah, thank you very much for your attention.
Yeah, thank you very much, Peter, for introducing this new concept, looking at banks, namely interconnectedness, and for this seemingly easy formula which you have developed. So let us open up the floor for discussion. And already Charles has raised his hand, and we may also have some, let's say, during the answer session, then some discussions between the panelists about their proposals. So please.
I just want to make a simple observation and then hope that we'll stimulate some discussion from that, which is a lot of the discussion today, as I said earlier, has found a lot of common ground on the idea that the incentives of uninsured debt are very favorable from the standpoint of a lot of the proposals here. And what's been interesting is we've had sort of three different ideas of how to get that incentive into bank decision making. Jack Coffey's idea, get it in there in the form of voting rights in shareholder meetings. Another idea is most of the presentations on this panel and the previous panel, get it in through the compensation of the CEO. And then another idea, which the last presentation had, and which I also have talked about, and others, is get it in through external market participants' incentives by requiring that they participate in the funding of the bank. I want to just point out that that's, first of all, it's interesting that there's a common ground in terms of the recognition of the importance of that incentive structure. But I also want to point out that I think that the emphasis on compensation is excessive in the following sense. All of the ideas that you can fix this problem through changing the incentives of the CEO depend on the fact that the firm is well governed and that the CEO is smart. And I would put back to you that the problem is that while that may be true sometimes, the problem may be that it's exactly in this recent crisis, it's been the banks that have just been poorly managed and where the CEOs weren't necessarily very smart may have been a contributor here. And so I think that that pushes back into one of the alternative two ideas, whether it's Jack's idea or Peter's idea, which is we need to have more voices than just the incentives of the CEO and the top management and how they think. And I think that's an issue that needs to be raised, that we're putting too much emphasis on this one small group of people and their wisdom and opinions.
Thank you very much. Avinash, I'll collect some more opinions before I get back to the panel.
Thank you very much. I agree with Charlie's comments. I want to focus a bit on Peter's very interesting idea. I think the problem is that I think Peter's right to think about interconnectivity. But the problem is the reason why we regulate the financial system is it's all interconnected. And we've had small banking crises. The biggest financial crisis in the UK was the 1973-74 small banking crisis. Had a bigger impact on the stock market than this crisis has had. And it's not just about banks lending to banks. It's banks being in common sectors. when crashes occur after booms. We discussed this over dinner last night. And as the boom is collapsing, you're getting deleveraging. In a deleveraging environment, every bank is connected to every other bank. So I think the ability to actually try and reduce this interconnectivity, I fear that it's not going to be possible to do. And take Northern Rock. Northern Rock is a bank which was interconnected with every other bank via its funding approach and model, not because it actually lent and borrowed substantially to other banks in the banking system. So I think we're going to have a real challenge in dealing with this. And I think we have to wake up and be, what's the word, realistic, that the financial system is highly interconnected, and it's very hard to find a bank that is so small that you're prepared to let it fail.
Thank you. Stefan? Can we have a microphone?
Points, it seems to me that even a small bank has huge psychological effects on the market. So this notion of too big, too small, if you look at just what happened in Spain with a tiny bank in the south of Spain going bankrupt, having a huge effect on all European markets recently. The other point is about interconnectedness. And here I'm kind of thinking, is this really a good idea? Because it could turn against itself, because in a sense, we know that markets experience liquidity crises when banks have difficulties to refinance each other. And if you implement additional rules in the wake of a crisis, you would make it even more difficult for them to refinance, which I think, as an economist, means that all the pressure would be then bounced back to the central banks. It means you would have to increase the ability of the central banks to cover and engage in those risks. And if you don't fix it on the other side, then you may end up with more problems than you had at the beginning. So I would kind of have mixed ideas about it.
Mm-hmm. Jack, yes.
I want to follow up on comments that were made by Jeff Gordon this morning and Lucian particularly this afternoon. Their suggestions are basically go ahead and improve corporate governance to give shareholders more power, but offset that, modify that, mitigate that by having close regulatory supervision of pay packages, this after-the-fact supervision of compensation. I think the one starting point that you have to build into any model that looks at the political constraints is what I'll call the sine curve theory of regulatory intensity. Regulatory intensity is not constant. If we look at the history of financial bubbles from the South Sea bubble on, we'll find that regulators are tough, punitive, harsh for a period of years after the crash. Indeed, Enron crashed in 2002, and we were certain one thing was going to happen. We would no longer see off-balance sheet financing. And now we look at what these banks were doing in 2005, 2006, and SIVs and liquidity puts are off-balance sheet financing. I suggest to you if there's one constant from regulatory history, it is probably that regulatory intensity will wane once we get back into the boom years. So from a standpoint of where you want to place your bets, you can place it on a compensation formula, you can place it on voting rights or liquid, or what I'll call dilution constraints, which is what contingent capital does, or you can place it on regulatory supervision. Certainly it's part of the package, but if you have great confidence in regulatory supervision remaining constant over time, I think that's short-sighted. What is predictably going to happen is that there'll be international regulatory arbitrage. Businesses in the United States will say this tough regulation is causing business to flow abroad to the United Kingdom, or regulatory agencies will suffer the usual revolving door problem as people come in from financial firms to take over mid-level and higher-level positions, and they'll define their role as to moderate regulatory intensity and introduce sensible deregulation. That happened for our last several financial crises. I predict it will happen again. It's not saying we shouldn't have regulatory supervision. It's saying don't place that much confidence that regulatory supervision will remain close for even 5 to 10 years. It will go through the similar sine curve that it usually does. At least that's my critique for those who want to put a lot of weight on regulatory supervision.
Jeffrey?
Yeah, I don't want to I don't want to respond directly to what Jack said. I think there's, I don't disagree with it. I do want to respond really to what Wayne said, because I think the point he made about executive in incentives based on stock ownership has a neat case in Richard Full's behavior when it came to the effort to raise new funds for Lehman Brothers from KDB and others. So the one thing we know is that as a firm gets in trouble, and the CEO knows the trouble better than anybody else, to the extent that he's got a huge amount of stock, which is now basically an at the money or maybe even out of the money option, the one thing he knows is that if he sells the firm to somebody else, if he enters into a capital raise, which is going to dilute the shareholder claims, basically he's wiped out, right? So he may not care about the shareholders who are out there in Dubuque, but he cares about his own portfolio. So what's neat about the suggestion that you make is that it overcomes the CEO's disincentive to try to bail out his own firm as it gets close to the line, right? If he switches from an equity share to a debt share, then all of a sudden he's got a real reason to try to draw more stock-based capital into the firm, which, given the ownership position he held, means he wouldn't. And so it could be that the most important sort of conversion feature is really for the CEO or the CEO team at a certain point, because that will dramatically shift the willingness to try to bring new equity into the firm.
Thank you. I saw two more. Hamid first, and then over there, and why don't you
Thank you. A number of related issues: too big to fail, excessive risk-taking, and compensation along the line that Charlie was talking about. As I stated this morning, 92% of the assets of a bank is debt. Ignoring the tax benefit associated with interest cost because of direct subsidy or indirect subsidy, basically the cost of debt is very low. Just think about weighted average cost of capital. As a result, weighted average cost of capital is enormously low, and a bank can undertake a variety of investment decisions that couldn't take before. So the bank can get larger. Also, you can run a regression, and my colleague can correct me if I'm wrong. Put the compensation on the left-hand side and a bunch of variables on the right-hand side. The biggest driver is the size of the institution. So in some sense, we, by providing direct subsidy, we help the bank to get larger, and also we subsidize CEO compensation. So we can go through that route and make some changes. The issue of compensation is enormously sensitive issue. Just think about 1907 crisis we had. It started in New York. The biggest firms on NYSE were insurance companies, and the crisis started with compensation and something which of the massive size as of now, although the stock market was much smaller. What did they do? The CEO of insurance companies took the firm from public firm, and they became mutual firm. We saw that again after 2003, Sarbanes-Oxley, many firms went private again to avoid the scrutiny of compensation. So if we just think that CEOs are self-interested, then it is, and they are like to take risk, whether we want to talk about excessive risk or any risk to enlarge the size of the organization. One very credible avenue we have is to go through compensation. I don't think we only need to rely on compensation or governance. And I think it's debatable how we should use compensation, but that's one instrument that we can use and effectively because of the subsidy, probably regulators have a right reason to control it and to manage the size of the organization and reduce excessive risk taking. Thank you.
Thank you very much. Then yeah, please. No, the microphone is coming.
Okay, sorry. Holger Sparman, a question for Wayne, or just a remark. You had those numbers about what increasing volatility would do in terms of profitability for a bank CEO who is subject to moral hazard. And I think you're probably, those numbers I'm guessing are standard option pricing. I think if you thought about a jump process rather than a diffusion process, you might get different results, because we're not really concerned about the CEO pushing up the standard volatility measure by 10%. What we are, I think, implicitly thinking about, I mean Lucian and myself, is the CEO taking some risk of a large drop in value, a catastrophic risk, in favor of some gains which will accrue in most states of the world. That's really the sort of risk that we're worried about.
Thank you. Good. The final intervention from the floor, or here?
I just thought I'd give a fact or two as a supervisor and one question. First, on the too big to fail, I think having been involved in a number of those decisions, it's a lot more complicated than the direct interbank liabilities. I just go to the fundamental thing I think about is the payment system activity. So, Bankhaus Herstatt, a classic example, small German bank almost brought down the financial system at one point. To one, Lucian, I imagine when you talk about regulating the incentives, you're talking of senior management, you're talking sort of the C-suite level of individuals, I imagine.
Yes, and that would lead them to make the right choices for the people below them.
And I agree with that. Just to give you practically, though, what is possible. So I've got a horde of $90,000 to $150,000 a year bank examiners. I can go into trading desks, I can go into origination businesses and look at those incentives and have confidence that even if the examiners make it a mistake, it's not going to be too bad. I got a real hard time having a $90,000 or $150,000 bank examiner go in and look at the incentives of Jamie Dimon and think that I'm going to be able to, in a judgmentally way, have him affect that behavior. That's an incredibly powerful decision to be delegating to regulatory discretion. So I mean, I would go to the point that there's limits to what regulation or supervision can do. Some of these things would have to be hard-coded into regulation. And because of the talent we have, it would cause us to focus on a certain level of activity at a firm and may get us to avoid some of the difficult stuff at the top of the firm, which is really what you need. I don't know how I make a lot at the Fed, and I don't know how I'm going to challenge Jamie Dimon on his pay, to be absolutely honest with you. I mean, it's a fraction of what he makes.
Okay, thanks a lot. Let's go back to the panel. Lucian. Sorry? Sorry, Eric?
No, it's
sorry, I didn't see your...
No problem. So I haven't followed this literature for a while, but one thing that struck me this morning is this persistence that there are certain institutions that persistently have more risk-taking, and that suggests to me that, and that's one thing I liked about Harald's paper, that he had actually some instrument for trying to see what is the causality here, and if you think about that problem from a regulatory perspective, so is it that firms that have this risk-taking behavior attract those kind of board members, those kind of investors, and or is it the other way around? I'm sure this literature has dealt with this, but of course, from a regulatory point of view, and it relates to the previous comment, how do you break this kind of pattern? Because it permeates way down in the organization, and it is a sort of a problem of endogeneity.
Okay,
thanks a lot, Lucian. No, it's okay.
Yeah. First of all, a reaction to the question that was raised about can the examiners do it, And that's connected to what René was saying before, that we need to be humble, and I fully agree with what regulators can do. But I actually think that this kind of stuff is much easier for them to do than many of the things that they do now. So right now, they've often to assess the risks of various positions. Whereas what I have in mind, and Holger has in mind, is things looking at, and I agree, it would be applying very clear principles that are very straightforward. So it wouldn't imply going to Jamie Dimon and saying, Jamie, you are making too much money. How about selling the mansion? No, it would imply having very simple principles like you should not be able to cash out too large a fraction of your equity instruments too quickly. Just a case in point, if you look at S&P 500 companies, the overwhelming majority of them have ownership guidelines which are completely cosmetic, which are really not meaningful. Now, Wayne said voluntarily people still hold, but I'm not sure why we should leave it to voluntary choices. I think firms should have clear, meaningful ownership guidelines, and I think that your examiners would be able to enforce it. Now, some reaction to what the panelists have said. It seems that Wayne and René are sympathetic to the concern that the externality might lead to excessive risk-taking. They are less persuaded by this problem of short-term, long-term horizons. And they raise both kind of theoretical questions and empirical questions. At the theoretical level, Wayne talked about, you know, kind of, it's not plausible to think that people would pump and dump. But really, I think that the plausible model to have in mind is not that in 2006 they did something knowing that in 2 years the whole thing will collapse, and in the meantime they bailed out. Rather, the idea is you operate the firm for many years with a somewhat elevated risk of a large loss down the road at a time uncertain. So the model that we have in mind is from 2000 to 2008, you all the time run things with a somewhat higher level that maybe down the road at a time uncertain, there will be a large loss. And you constantly take some money off the table. If that is the model, and if you work through the math, it's a very consistent model, then just looking at 2006, and you see that you have a lot of chips on the table, that doesn't tell us anything, because in each year you have a lot of chips on the table, you take some, you get some extra, and the basic outcome of this model is that you will be operating at a somewhat elevated risk Secondly, there was this question about should we really think that the markets are inefficient. I mean, we are not, the reason, we shouldn't assume that markets are, I mean, Patrick has models in which the market is kind of irrationally inefficient, but there are standard models going to Jeremy Stein that say, as long as there is private information, and this is a context where it's very reasonable to assume that the executives have private information about the quality of risk they are taking, you are going to have possibly their choices not reflected in market prices, and you might have inefficiency. So on the theoretical level, that's something that just makes sense, and the only question is an empirical question. Does it happen, or more importantly, it's bound to happen on the margin? Question is how important this is. And here, I kind of would like just to leave you with kind of the question about what priors should we have when we ask about this question. So Wayne was saying, look, I'm not persuaded, I haven't seen the empirical evidence that this is a problem. René, if you look at the paper, he has some of that too, because most of the results are results where he tests something and it doesn't have statistical significance. So he says, I don't find evidence that this is a problem. Now, let me tell you, if you look for such evidence about whether bonuses raise performance, we know that they're true better than anyone. We don't have solid empirical evidence that shows with statistical significance that bonuses improve performance. Even the evidence on option compensation versus performance is not all that strong. Now, the reason why we all, or most of the people here accept it, and I've been writing in favor of bonus schemes and in favor of equity compensation, is because we are saying, well, we haven't, it's very difficult to show those things, but in terms of the economic logic, it goes back to principles of economics. If you have an agent and you give them good incentives, until persuaded otherwise, we have to think that this is, this is the right way to go. So somehow the question is, if we see a situation where, and the Bernstein is just, just an illustration, we basically have a structure in which, because people can take a lot of money off the table, and they actually do, there is a divergence of interest between them and long-term value. To me, as an economist, it makes me feel concerned, and I would need, kind of my prior about this would say, unless you come and tell me that, I've shown you that this is not really creating a problem, I'm concerned, and I would like to have a better designed compensation structure in the same way that I think we should have pay for performance. And therefore, I think that, we might all want to think about what is financial economy should be our priorities. And the last comment on this, and I'll stop here, we have the same question about priors when we think about what inferences do we take from performance. So I've been writing about compensation, about governance for some time. And, 5-10 years ago, I've had some debate in print with people who were saying, well, those problems are not that big. And they would always make the argument, and they would say, look, maybe you are theoretically right, but the system has been doing very well. We have had this boom for 10, 15 years. So you shouldn't really think of success. We should really infer from this that the system is working well. Now, the system has not been working all that well, at least the last time I looked at my 401k account. The system has not been working greatly in the last 5 years, or now even over a 10-year period. So to me, that makes me think, gee, maybe we should be more receptive to this theoretical argument that incentives are not working well. But it seems that people are saying, look, we were very willing to give a lot of credit to compensation structures when things where performance was good, even though the link was not so obvious. But you should prove to us that this bad performance we have had in the last several years is a result of compensation. And I think we might want to think about being symmetric about this as well.
Thank you, Wayne.
Okay.
Well, stage is set.
I mean, just I guess since Lucian finished with it, I'll start with it. I mean, the issue of the relation between incentives and performance, and whether we want evidence that incentives are tied to performance. I mean, clearly, as academics, and in general, we'd like evidence of what we're trying to say is going on. But I would be a little bit careful that the inability to document a simple relation between incentives and performance is not to be interpreted as evidence that incentives don't matter. One perfectly plausible interpretation is that incentives do matter, and that corporations are structuring their incentive plans optimally. And when you see someone have more paper performance or less paper performance, or more options or less options, it's because that's the amount of pay and incentives that are necessary to drive optimal performance. So a perfectly plausible inference from no relation between incentives and performance is that firms are doing a pretty good job of setting incentives and pay to maximize shareholder value. I mean, that's what you'd expect to find. So that's one point. Another point with respect to the executives having regulating guidelines as to whether executives should hold certain amounts of equity, I don't have a problem with requiring a board to have a guideline. I would be more cautious if we said all firms have to have the same guideline, or there's a certain amount that everybody should have. I mean, one thing we do know for sure from the literature is that one size does not fit all on nearly any dimension of compensation, incentives, or governance, that there are cross-sectional variations in the demands that firms have for certain types of governance structures, and requiring firms to have policies and disclosure is perfectly reasonable. And I would like to emphasize a little bit more on disclosure because a lot of the recent proposals by the SEC and others to disclose more about executive pay, they really have focused on the level of pay. I mean, a lot of the recent proposals have been on, tell me more about your supplemental retirement plans. Tell me more about perquisite consumption. Tell me more about the bonus plan and how much you're getting for certain things. Relatively little, and I think maybe there's a belief that it is there, but I don't think it is. Relatively little of that disclosure is focused on, tell me how the incentive structures really work. Can you give me a table that says, for a so many % increase in stock price, this is how much extra my CEO is going to be worth or is going to take home. For this much change in volatility, asset volatility or equity volatility, this is what it would imply for the wealth of the CEO or the top management team. And to try to quantify, we do that with derivatives. I mean, firms have to disclose different tables about their exposures to various types of risk in terms of financial instruments. I don't see any reason why we can't do it with compensation. And to my mind, that would be much more helpful to lay out on the if we want to talk about excessive risk-taking incentives, let's first get firms to disclose what their risk-taking incentives are, try to quantify some of that so we can figure out what it is rather than to just try to guess. And the last point I would make is that in terms of the short-term incentive issue that Lucian was talking about, the pump and dump, what the story is, how executives would take advantage of it. I mean, I guess I'm just a little confused as to what the story is, because Holger started with his idea was that it wasn't about little risks, it was about the catastrophic risk. And Lucian's point was, no, it's about taking little extra risks over a long period of time. And so I'm just not sure what the story is.
You're always operating at a slightly higher risk of a catastrophe. So basically, all the time, you should run the firm with a 5% chance of a meltdown, and you're running the firm with an 8% chance of a meltdown, and each year you are taking some chips off the table. Right. And if you just write down the model, you'll see it's a perfectly consistent model. It's a question empirically how important.
But René actually pointed this out. I mean, the key issue is at a point. I mean, this works fine. If you look back, after a catastrophe, if you look after the period leading up to a catastrophe, that's almost by definition a period when a catastrophe didn't happen. And if you look at that lead-up period and look at how much pay they made, you're going to find that they received a lot of pay and a lot of takeaway. But the issue is, René pointed out, at a point in time, if I'm standing there today, what are my incentives to take a 5% catastrophic risk and throw the firm under the bus and my career under the bus? And it all works fine if I know the catastrophic risk is going to hit 10 or 15 years from now. But if I'm always operating with a higher probability of a catastrophic risk, the issue really is at a point in time, what do my incentives look like? And I'm not sure that story holds up.
This is really the Jeremy Stein model. If you just write it, the Jeremy Stein model just tells you if each year you are... Yeah, sorry.
I suggest you continue this discussion over the coffee break, and we still give Peter the chance for his final comments.
I can be brief. First, I want to repeat that my proposal is not the solution for all problems of the financial industry. I think it's one contribution which I think has its merits. And of course, it's clear once you are in a deleveraging process, as you said, it's too late. But I think the rationale of such a proposal is to prevent the party from getting out of control. I think once a party is out of control, it's too late. But such a rule might help to keep the party better under control, because you have to ask yourself as an investor, do I give my money to this bank because it could be the only bank that fails and then my money is away? I think that's what would be fundamentally different with such a rule from the present situation. That's where I see the advantage. And well, as it was said, that small banks can have huge psychological effects. This is true as long as I have the feeling that everything is extremely connected. Yeah, but then of course also a small bank like IKB can create such problems. But my view is it's important to prevent a new party getting out of control. I think that's what such a rule could contribute. I think it's true that it's difficult to implement it, that it has effects on the settlement system between banks, and maybe one it's better. It fits better with the cross-settlement system than with the net settlement system. Maybe one has to think about the whole role of the central bank in refinancing banks. So maybe the whole overnight. The question is the overnight market. Is this something that has to be done by banks, or wouldn't it be possible for the central bank just to offer an overnight facility for all banks as long as they have collateral? So one has to think about these things. That's quite clear. But I think it's worth it because there are not so many other good solutions. This morning, everybody was talking. Several people were favorable of contingent capital, but it doesn't work. If you have banks that are heavily invested in this contingent capital, and then you convert it, you create a problem with all these banks. So if you don't have the diversification, you cannot credibly convert it. Your proposal, yes, but the other proposal where just convert it into equity, then you create lots of problems for all the banks that are holding it. And so therefore, I know it would, as I said, this would somehow change the financial landscape, but I think it's worth to think about.
Yeah, thank you very much. We have come to the end of this session, and I want to thank all the panelists and all of you for the very lively discussion we had, which was especially positive from my point of view since it was the after lunch session. As was to be expected, we didn't find a magic formula to solve all these problems. But my feeling somehow is that we approached, that we narrowed down on certain objects, let's say the more feasible ones actually, and this is, let's say, where the discussion in the next session should concentrate on, and perhaps at the end we have something which we all can agree on. So thank you very much, and I suggest we have a coffee break of 20 minutes, so 5 to 5. We'll meet again here for the final session. Thank you.